In this video, we will discuss when is the best time to pay your credit card bill, how you should pay, and what are the best strategies to increase your credit score. Welcome to Finance Dojo. We aim to be the best personal finance educational channel you'll ever need. Click that subscribe button and the notification bell right now so you won't miss out. Your credit card statement allows you to choose the amount of your payment and provides you with a variety of payment options. The ideal way for paying off your credit card is determined by your budget and financial objectives. You might be confused with all the different figures on top of your credit card statement. So, I'll break down what each one of these actually mean. This is the amount owed during the statement period or billing cycle under new balance. The minimum payment due is right next to it. This implies that you must pay this amount throughout the statement period in order to avoid being charged late fees. Depending on what type of card you have, this can range anywhere between $25 to $35 per month. Now, this is the payment due date. This is the date that you must make your minimum payment by. Remember that you need to make the minimum payment before the due date, so you will not be charged with late fees. However, for any billing cycle that you do not pay the balance in full, you'll be charged with interest on that balance. And depending on your credit score and credit card, this can range from 14 to 25%. Most of the time, your statement will also show your credit limit. Let's use a credit limit of $11,000 as an example, and the available credit during this billing cycle is $10,500. So how this number is calculated is by taking your credit limit and subtracting your new balance. You may also see how many days are inside of your billing cycle in your statement, in which majority have a cycle of either 28 to 31 days. Next question. When exactly should you pay your credit card bill? The answer to that is don't be late in making your payments and pay your balances in full every single month before the statement due date. The biggest benefit of a credit card is that it provides you with another source of passive revenue. That may only be 1 to 5% return on a single category, but it's still money you'd be making since you'd be buying goods you'd have bought anyway. Now let's talk about when you should pay off your credit cards to improve your credit score the most. You will receive your credit card statement in the mail or via email. This information will then get forwarded to the credit bureaus, TransUnion, Experian, or Equifax. Let me go over this again. What goes into a credit score? Imagine a pie chart that equals 100%. Your payment history accounts for 35% of your credit score, while the amounts owing or credit utilization accounts for 30%. New credit accounts for 10%. Length of credit history accounts for 15%. And your credit mix accounts for 10%. So for your credit score, 65% of it comes down to your payment history and amounts owed. When it comes to the amounts due or credit utilization, which accounts for 30% of your credit score, the amounts you pay on your credit card statement will play a role. For example, you have one credit card and your credit card limit is $8,000, and during 1 month, you decide to buy a few things like a laptop, a new smart TV, or some gadgets, and this all costs you $4,000. This information will already be submitted to the credit bureaus if you wait until your credit card statement arrives in the mail. $4,000 of $8,000 is 50% credit utilization. The higher your credit use, the greater the danger you pose to lenders, and the worse your credit score will be. A good number of credit utilization amongst all accounts is around 30% or less. So if you're planning to make a big purchase on your credit card, it's best to make early payments. By the time you get your statement, you have a much lower balance. And once this information is sent to the credit bureau, it will appear that you are using this card, but that your credit usage is low. As an example, if you put $4,000 on a credit card with an $8,000 credit limit, pay off $3,000 as soon as your next statement arrives in the mail. It will just show that you have a fresh $1,000 balance. Your information will be submitted to the credit bureaus, which will boost your credit score significantly. There are credit cards that offer a 0% APR for the first year. These are like standard credit cards, but during the first 12 to 18 months, they are a little bit different. When you charge a debt to this credit card, you won't be charged interest for at least a few months or until the promotional period ends. Depending on the credit card you have, you may only be required to pay a certain amount each month to retain the card at a 0% APR. For example, you may have a $10,000 credit limit on one of these cards. You put $9,000 on this card each month, and you must pay $35 each month. You will not be charged any fees or interest as long as you pay $35 per month. However, because you carry a debt on a credit card with 0% APR, this will affect your credit usage. Let's just say that you have two credit cards. One credit card has a 0 APR, and the other one is just a regular credit card. Each one of these credit cards have a credit limit of $10,000. Your 0 APR credit card has a balance of $8,000, and the other credit card has a balance of $3,000. So in total, you have a credit limit of $20,000 and a total balance of $11,000. As a result, your overall credit usage is 55% in this instance. Even if you aren't paying interest on the card with a 0 APR, the fact that you have a high credit usage will have a negative impact on your credit card. However, keep in mind that your credit score might change at any time. Your credit score will increase over time as your credit use decreases and your credit history grows. Turning on your auto payment function is another way to pay down your credit card. This function is available from every credit card company. They generally have two choices: pay the minimum payment each time the balance is due, or pay the full balance whenever it's due. My advice is to set up an auto payment for 4 to 5 days before your amount is due, and to have it set up to auto payments for the new balance as well. You will never miss a payment this way, and you will avoid fees. Furthermore, by making not only the minimum payment, you will save money on interest. But remember, if you decide to have your balance paid in full every single month with auto payments, do not make extra payments, because if you do, you may just be overpaying the credit card company, which means that the cash is just sitting there until you spend it, unless you ask for a check. So, the only poor time to pay off your credit card account is after its due date, because this can have a number of negative consequences, including lowering your credit score and requiring you to pay late fees and interest. It's never a smart idea to pay more than you have to. However, if you pay off your credit card balances in full every month before receiving your credit card statement, the credit agencies may not notice that you are really utilizing the credit, which has no impact on your credit score. The most important thing to remember is to keep your credit utilization at 30% or below across all of your credit cards. And when that statement arrives in the mail or through email, simply pay it in full. You get the best of both worlds this way. As always, this video is for educational purposes only and not financial advice. You should always do your own research and speak to a financial advisor before making any investment decisions. Thank you for watching and see you in the next one.